Hey everyone, welcome back to this week's Teaching Thursday. We got a great topic which actually you guys are going to love, and that's investing screeners. You might hear people talk about stock screeners and things of that nature, which are usually within your brokerage firm. But to really kind of give you an example of how a screener works, think about when you sign up for a Groupon or a Living Social. So when you sign up, you usually put in the location that you're living in, right? And so now that's going to automatically narrow down deals to a certain geographic region that's close to you. Within that geographic region, you might have other options where you can choose like vacation deals, arts and crafts deals, services, games, whatever you could think of. There's different ways, there are different things that you can pick to continue to narrow that down. Another example would be if you're shopping on, Macy's website. On Macy's website, you go to the women's department. Within women's, you can choose boots and accessories. Within boots, you can choose, only black boots with the 2-inch heels, so on and so forth. All you're doing is you're narrowing down and getting rid of all the fluff. You're screening for what exactly you want so you don't have to kind of sift through all this stuff and it gets confusing. Well, that's how an investing screener works. You're just coming up with a plan to help you really decide what it is I'm going to invest in, and this is what I want, and that's what I'm going to buy. So here we're going to just talk about stocks, bonds, and funds. And within funds, we'll just kind of group together index, ETFs, and mutual funds all together. And so we'll just kind of make some generic screens. I put 5 here. We might fill them up. We might not. And it could be more, depending upon what you want. But let's start with stocks. And let's just say I like to travel and I like to shop. So first off, I'm going to say, you know what? I'm only going to look at transportation. So we'll put transpo and retail stocks. Transportation because I like to travel. Retail because I like to shop. Your retail, your Nordstrom, JCPenney, so on and so forth. So that's part of my screener. And now, you know what? I don't want to spend more than $50 a share. So we'll say the stock price has to be less than $50 a share. Now, I don't want you to think that a low stock price means it's a good company or a bad company and vice versa. The price might be $40, but its forward growth means it's really worth a $60. It's really a $60 stock. Or if it's a $100 stock, it really might only be a $70 or an $80 stock. I don't want you to think that the price is really what determines the value of that stock. But let's just say you want to be able to buy a few shares, so you cap it at 50. Then also, since it's less than 50, you're expecting some decent growth, but you also want to kind of hedge the bet. So you want the stock to have a dividend. Okay? And make sure you check out our video on dividends and capital gains, things of that nature, so you can really understand what kind of gains are out there when investing in these stocks. So you like to travel, you like shopping, you want the stock to be one of those two sectors or industries and less than $50, and it pays a dividend. And then lastly, you want the net income of the company, which when you look at a profile, it's your earnings per share. Remember, check out our video on EPS. Remember, let's say your EPS is, let's say you have 1 million shares and the company makes, $2 million. Well, the company earned $2 million over 1 million shares, so your earnings is $2 per share. So you want the EPS, let's say you want it to increase by at least 10% every year. So now, a great resource for this is a NASDAQ website. You can go and look at the company's revenue and their net income in there, and you kind of just do some calculations. And this could be the past 5 years, the past 10 years, whatever you want to choose, but you want the earnings per share to increase by at least 10% every single year. And let's just kind of leave it there for the stocks. So you want to invest in transportation stocks and retail stocks because you like to travel, you like to shop. You want to be less than $50 because you feel that that's just a price that you like. You want it to have a dividend because you want to kind of hedge your gains just in case they're not that much or the stock might decrease. And you want the earnings per share to increase by at least 10% every year. And the reason you want the earnings per share to continue to go up is that means that the company is making more money in profit. So that's your stock screener. And from that, you go to your broker or Yahoo Finance, whatever site you're looking at. You look at transportation or retail stocks. And within there you can probably set something in there where the max price is $50, or you can kind of just scroll through, browse a little bit. Then you see if the stock pays a dividend. If it doesn't, it'll just say NA for not applicable. And for the EPS, that'll require a little bit more work, but you can always find that out through a company's 10Q on Yahoo Finance or the SEC website, which is Securities and Exchange Commission. And you just search that through the Edgar database. I actually have a video on kind of how to navigate that as well. And this is your screener for investing in stocks, and you just stick to it, and that's what you consider, a value investment for yourself. Now let's move over to bonds. So let's say for bonds, you want, you want to be the safest possible investment. You don't want to deal with anything major. So you're like, okay, I'm only going to buy treasury bonds. Okay, so you cut out municipal, you cut out corporate bonds. I only want to buy treasury bonds. Let's go ahead and fix that. So from that, you say, bonds, they have to pay an interest rate. So with that, you're like, you know what? I need the interest rate to be at least 1%. So let's say 1.5%. So you want your interest rate to be greater than or equal to 1.5%. So this means that for every $100, so let's say you got you paid $1,000 to get the bond, you're going to get $15 every year in interest, and you split that up normally into 6 months. So you're going to get a $7.50, check in the mail or distribution, whatever, throughout the life of every 6 months throughout the life of the bond. Normally, treasury bonds are, they're going to be, they're going to be 20, 30 years. Okay, so for 20 or 30 years, you got this bond, you're going to get $7.50 every 6 months. That's part of your screener. And that's it. You're like, I only want treasury bonds, and I want it to be greater than or equal to 1.5%. And that's your bond screener. You're cool with that, you leave it there. Lastly, for the funds, you're like, okay, what kind of fund am I looking for? I want it to be diversified. So diversified. So maybe you don't just pick a transportation ETF. Maybe you want to pick more of a broader. You can get a SPY, which is the S&P 500 ETF, and that's more diversified. That's just kind of like an index fund. It's just tracking the S&P 500. So you want it to be diversified. That's one of your screeners. You want the expense ratio to be less than 2.5% because you don't want it to really eat into your profits. That's really not something that you want. And you want it also to pay a dividend or a distribution. Mutual funds, you're normally going to get some kind of distributions, but with ETFs, you're not always going to get a dividend. It just depends. A lot of times you will, but the dividends can also fluctuate. And so these are your screeners. So let's say you want to have a diversified portfolio. You say, I'm going to buy 5 stocks this year. They're all going to be in either transportation or retail. I'm going to buy them for less than $50. All of them are going to have dividends, and they're all going to make at least 10% more every year. Then I'm going to get some bonds, but I'm only going to get treasury bonds, and I need to get at least a 1.5% interest rate payment back. And lastly, I'm going to get a few funds. I might get an index fund or ETF, but I want to make sure that those funds are diversified, their expense ratio is less than 2.5%, and they pay a dividend. So now you've just created a whole portfolio from this screener that you have, and you narrowed it down. You got some stocks, you got some bonds, and you got some funds, and you're well diversified, but you also have different things in there that meet the needs that you want. And that's how an investing stock screener works. So anytime you're thinking of a screener that you want to develop, think about all the things that you want for a company to have. And a lot of this you can just read articles, whatever. I actually have, if you go to thedaddydaughterfund.com, I kind of have a screener on there for my dividend stocks, and just kind of see the idea of how people think. You can always just research, investing or stock screeners, whatever, and see what other people do and come to a conclusion of what you like. And just think about, the Groupon thing, the Macy's website, or the Living Social deals, and that's how you make a stock screener.